Hello, I'm Tim MC with Finance Agents, and today we're going to talk about your FICO score. You might know the number, but how the heck did they come up with that magic number that has the ability to ruin your life? All right? And if you stick to the end, I got a special bonus tip that'll tell you how to quickly and easily boost your score by as much as 100 points. No joke, I've seen it work for a lot of people. Stick to the end, and we will cover that. All right, first of all, FICO score, what is it? FICO, F-I-C-O, stands for Fair Isaacs Company. And they are the evil geniuses, wizards, whatever you want to call them, who created this algorithm, this numeric system that determines how your life goes, all right? Now, over the years, they have changed this number a bunch of times. But you may be thinking, I got Experian, I got Equifax, I got TransUnion, these are different reporting bureaus. But in the end, they all use the same system. The FICO score, there have been 9 different scores over the last I don't know how many years, and all the banks use different ones. They use whatever the heck they want. Hey, I like FICO score 6. Then they're going to use FICO score 6. And every once in a while, they come out with a new FICO score. And if you read the news, you get all this hype. Oh, FICO score 9's coming out. It's going to change your life. They got these cool things. Honestly, the reality is, has no impact. It will not affect your life anyway. Don't believe the hype because the impact is all right. So besides just the main basic versions of FICO, they also have special ones for auto, special ones for mortgage, special ones for credit cards. And you have no idea which ones the banks are using, but guess what? They're all about the same anyway. So don't worry about it. The first category of thing that goes into making your FICO score is your payment history. You might be thinking, yeah, no kidding. All right, this is a pretty obvious one, and it's obviously very important. So when we go through these 5 things, we're going to give each one a percentage for importance. So how important do you think the payment history is for your FICO score? Guess what? Hint, it's pretty important. All right, so let's go into this. When you actually have an account, it gets calculated based on how much you pay your bills or how late you are, right? So when you're looking at credit reports, you might see a 30-day late or a 60-day late or a 90-day late or, help me God, I hope not, 120 days late. Always shows up as dead black. You're basically dead to the creditors. Avoid that by paying your bills, obviously. The more you pay your bills, the less of those you're going to get. And by having a good payment history, you're going to have a better score. How much better? The payment history is 35% of your overall FICO score. So, and it, like I said, it's the largest individual item. So the easiest way to make your scores better is to make your payments on time. But it's hard to do that quickly, right? Making your payments on time, you need to do it for 7 years for them to care. So you got 7 years. You know, it's never too late to start doing the right thing, but it's going to take a long time before you fix that. The next category we're going to talk about is credit mix. What's a credit mix? Funny you should ask. All right, well, let's see. Credit mix is a combination of all the different lovely things inside your credit. Might be credit cards, might be retail accounts like that Kohl's card where you're always getting those awesome discounts. Could be an installment loan like a student loan or personal loan. And of course you got the mortgage. A mortgage is a big one. The banks love it. And when you have a mix of these things, they really love it. By the way, it's good to have a mortgage on your credit. You know why? One, it's hard to get them, so the banks already think that you're cooler because you're part of the cool club because you got that mortgage on there. That's one. But 2, they know that if they sue you, they could put a lien on your house. All right? It all comes down to getting paid when it comes to the bank. So how important is your credit mix? Well, let's see. Boom, 10%. 10% of your whole FICO score comes down to having a good, healthy, lovely, tasty mix. You want that? Tasty mix. Yummy. All right, so we've talked about payment history. We talked about credit mix. The next one we're going to talk about is new credit. Oh, so how long the stuff has been there, or if you're just getting some new stuff right now, it's a big deal. How important do you think new credit items are to your score? Well, let's dig into it. What the heck are new credit items? First of all is inquiries, right? If you go apply somewhere, an inquiry goes on your credit report, each one takes about 3 points off your score. That's a general rule. Don't quote me on that, but I mean, feel free to quote me because that's pretty much right. Pro tip, Fight the inquiries. Anytime somebody asks to pull your credit, just say no as much as possible. You're going to go rent someplace, say no. Get them to pull somebody else's credit. For annoying, people are always asking to pull my credit because we work with all these different vendors and lenders, and they all want to get in your business. They want to dig in your business. Tell them to do a soft pull, right? We don't need hard inquiries. A hard inquiry shows up on your credit, it matters for 12 months, and it drops your score. No bueno. Okay, new credit items, there's 3 types. There's inquiries, new accounts, and okay, there's really just 2 things. Inquiries and new accounts, but another factor there is the type of new account you got, right? A brand new credit card is generally worse than a brand new mortgage. You may be thinking, wow, the credit card, I actually have 0 payment, it's brand new. Mortgage, I'm paying $5,000 a month or whatever. Still, they'd rather see a new mortgage than a new credit card. Why? Remember I said this already. If you got a mortgage, they know that they can sue you and put a lien on your house. Suck on that. Not fun to know, but it's the truth. All right, so inquiries, fight them every chance you get, beat them up, just say no. New accounts, only get it if you want it, right? So when you go to Target, every time you buy some toothpaste, they'll say, hey, you can save 10% on your toothpaste by opening a new Target card. Say, get out of here. Or politely say, go to hell. Or just say no, or don't say anything at all. Give them the cold stare. Just walk away. Whatever you do, don't get the card unless you really want it. There is no benefit to getting a Gap card, a Nordstrom's card, a Macy's card, a Target card, a Jiffy Lube card, whatever the heck. Everybody wants to get you a card these days. Just say no. When we're talking about inquiries, there's hard inquiries and soft inquiries. What's the difference? A hard inquiry means a lender pulled your credit and it's going to show up there for a year. No good. Soft inquiries are when whoever you're talking to is able to do it a special way where it shows up as a borrower inquiry instead of a lender inquiry, and so there's no new inquiry placed on a report. We like that. You might be thinking, that seems to defeat the purpose of the system, and unfortunately FICO agrees with you and so do the credit bureaus, so there's a big crackdown on, there have been a lot of lenders over the last few years that have been doing soft pulls instead of hard pulls. We love them, thanks for trying, but now everybody's coming after them, so that might go away. But if there's a chance, ask, hey, can I get a soft pull? Can you hook me up? Can I get a soft pull here? Hey, be nice. Flirt a little bit. You might get a soft pull. All right, so we talked about new credit, all the different kinds. Are you still watching? How much does that matter? Payment history is 35%. Credit mix is 10%. New credit, how much? 10%. All right, now we're up to 35, 45, 55% of your FICO score is determined by payment history, credit mix, and new credit. The next item that determines your FICO score, item number 4, is the length of history of your account. So you need to open your first credit card as soon as possible, preferably at 11 years old or whatever. Right? I don't even know if you can do that. But earlier is better. You want long and big. Long credit history and big credit cards, or get an installment loan as soon as you can. It helps you establish your credit so you can make sure to get in lots of debt later, right? You want to build it up so you can get overwhelming amounts of debt that are impossible to dig out from. No, that's not the goal. I can't tell you how many times I've seen somebody close a bunch of credit cards. They say, I'm going to make my credit better. I'm going to close all these cards and just keep the one, and I'm going to make it be perfect. And guess what? You just screwed yourself because you just chopped off 12 years of credit history with those other cards. Bad news. Keep the old cards. Try to keep your cards open. Just don't have any lates. All right? Set up auto pay, for crying out loud. Auto pay. Not hard. Just check the little box. Pay the minimum every month. Well, of course, you want to go in and pay more, but at least pay the dang minimum. Auto pay. Auto pay is your best friend. How long matters how much? Does it matter more than new credit or the credit mix or your payment history? Guess what? It is 15% of your FICO score, is that length of history. Like I said, longer is better. All right, if you're a math genius, then you're going to know that 35 plus 10 plus 10 plus 15 equals 70%. Can you figure out how much the last one's worth? I'm going to give you a second. No, I'm not. The last one we're going to talk about is the amounts owed. The amount owed on your credit is very important, and it's the easiest thing to manipulate on your report. Amount owed comes down to different things like total balance of total debt, total balance of credit card debt, total balance of credit card debt in comparison to how much you could borrow, right? If you got $10,000 in credit cards, but you're only using $5,000, that's a 50% debt utilization ratio, right? That's better than having 100%, you're using the whole 10K. Also, the number of different cards you have. That's important. If you got 20 cards, lenders are going to say, what the heck is this guy doing, right? Also, what percentage of your debt is credit cards versus mortgages? Do you got that magic mortgage on there? We should start calling them magic mortgages because they are. They're magic for you, and they're magic when they want to put a lien on your house. They're magic for that too. So, now remember, I'm not done yet. I've got the special tip where I'm going to show you how you can boost your score by 100 points in the matter of 30 days. Almost anybody can do it, and I'm going to tell you why in just a second. Who wants 100 points? Huh? If you want 100 points, hit that like button. All right? What would that mean to you? Would that mean a lower monthly payment on your mortgage, a lower monthly payment on your car? It means an extra credit card that you can get where you can use it to start a business? It means a lot of things, right? Maybe it means that you can rent that apartment where before they were saying, oh, wait, get out of here, Mr. 560. All right, no more suspense. Now I'm going to tell you the absolute quickest way to jump your credit score by 100 points. This is how you mess with the FICO score. Hey, FICO's messing with you. Here's your chance to mess back. The FICO score is really just a calculation of how likely you are to default on your debt in the next 30 days. All right? What's the easiest thing you can do to make it look like you are not going to default on your debt? And I'm going to say it, and first you're going to think, huh? That's not easy at all. Guess what? It is, so stick with me, all right? The easiest way to boost your FICO score by 100 points in 30 days is pay off all your credit cards to zero. Now again, stick with me. I'm going to tell you how to. I'm not just going to drop that on you and mic drop and walk away. Pay your cards off to zero. I can tell you, when I've seen people pay down their credit cards to $0, it makes a huge impact. And sometimes that extra 20 points change on your FICO makes the difference between getting a 3% interest rate on a mortgage versus a 4 or 5% interest rate. And that calculates down to, maybe $500 a month you're saving on your mortgage. That's a big deal, right? So don't just pay off your cards to zero. Go out and get business credit cards that don't report to your personal credit. Don't close your personal cards. Get business cards. Use business cards for your expenses so that your FICO score always stays clean and you always show these zero balances. I've done it. It doesn't matter. There's nothing wrong with getting these business cards. It doesn't mean you have to file taxes on these business cards. You can get business cards with the DBA. You don't have to have an LLC. You don't have to have much of anything. Pay off your personal cards to zero and use business cards that don't report to personal. Those two things together, boom, will boost your score as much as 100 points and keep it up there, maybe more. Now, if you carry zero balance anyway, sorry, I can't help you, right? But if you're like a lot of people, you pay up and down balances on your cards, pay them off, and put your future balances onto business cards. Now, again, you may be saying, how the heck am I going to pay off my cards? Right? I talk to people all the time. They got 50, 60 grand on their credit cards. Hey, I'm not, it's not always easy, but it doesn't have to be too hard. If you can qualify for even one business credit card now, you can open the card, do a balance transfer. Then you may see that your credit score goes up 30 or 40 points. Now you can get a second business card, and you can balance it and transfer the next one. Then your score goes up again. That's sort of the slow step way to do it. Some people don't qualify for business credit right now because they have too much debt. Here's 3 ways to pay off your credit cards fast if you don't just have the cash in the bank. First, go to a family member. Hopefully your family likes you, or loves you even, if you're lucky, and they will be willing to pay off the cards, hold the balance for, say, 30 days while your score improves, and then you go get some business credit cards that don't report, and then you transfer the balance onto the business cards. That's the easiest thing. Hopefully you have family members. If you don't have family that like you, and I get it, not everybody's family is awesome, you can go to friends. Friends are cool. Friends will sometimes do it. You might have to convince them a little bit more. Hopefully you got some good friends. But if you don't have family members that can do it, and you don't have friends that you can do it, there is another option. You can go out and find an investor who will lend you the money to pay off the cards. They'll usually make the payments for you. Then you can go through a program like one we have here that helps you get business cards, and then you can pay them back. Usually the investor won't work with you unless you're going through a service that has a track record, right? And if you don't know how to do that, we have some investors that will do that for you. So those are your options. Get a family member to lend you the money, get a friend to lend you the money, or get an investor, and of course there's going to be a cost for that. But what's a greater cost? Pay an investor for a short period of time so you can improve your FICO score considerably, or continuing to have crummy credit forever, right? Maybe once you fix it, you won't screw it up again.